All right, today we're going to dig into a really fascinating investment thesis. It says that the most boring sector in the entire market, I'm talking utilities, might just be the most exciting trade of the decade. Seriously, it's a story all about AI, interest rates, and what looks like a massive market mispricing. Let's get right into it.
This quote from Elon Musk just perfectly sets the stage. And he's not kidding. The single biggest roadblock for the whole AI revolution? It isn't better chips, it's not smarter code. It's power. It's as simple as that. Can we generate enough electricity to plug all this stuff in? And that, right there, is the entire trade in a nutshell.
So who's going to solve this massive power problem? Well, that brings us to the main character of our story today, the utilities sector. You know, the companies that own the grid, the power plants, all the transmission lines. And for decades, they've been hiding a pretty big secret right out in the open.
For as long as any of us can remember, the story on the left is what we all thought about utilities, right? Safe, sleepy, something your grandparents bought for the dividend check. But the new story on the right? It's a complete rewrite. Utilities are now the critical bottleneck for AI, the absolute essential infrastructure for our future, and they're staring down a demand curve that is just completely explosive.
So what's actually driving this massive shift? Well, it's one thing above everything else. AI's unbelievable, just insatiable hunger for electricity. The scale of this it's honestly hard to wrap your head around, but the numbers? Wow, the numbers tell a wild story.
Just let this number sink in for a second. By 2028, some projections are showing that AI data centers could be sucking up nearly a quarter of all the electricity generated in the entire United States. I mean, to put that in perspective, all U.S. households, every single home, they use about 38%. We're talking about AI's power needs getting into the same ballpark as every house in the country. It's nuts.
And look, this isn't some slow, gradual creep. The growth isn't a straight line, it's a vertical launch. We go from about 4.5% of the grid today to potentially over 20% in just 4 years. This is the definition of a demand shock, the kind of thing our physical infrastructure is just not built to handle on the fly.
And you know this demand is real because it is backed by staggering amounts of cash. The biggest tech companies on the planet are projected to be spending over $1 trillion a year by 2028, mostly on building data centers that need power. Every single one of those dollars has a giant electricity bill attached to it. They are desperately chasing watts.
But here's the thing. The AI story, as huge as it is only one piece of this puzzle. It's actually converging with these other massive economic forces to create what the source material calls a perfect storm for the utilities sector.
A really crucial piece here is interest rates. You got to understand, utilities have always been super sensitive to them. When the Federal Reserve starts cutting rates, utilities tend to do really well. In past cycles, we've seen returns of 25, 30, even over 40%. So the argument is that we are entering another one of these rate-cutting cycles, which gives this whole thing a massive historical tailwind. And that's before you even factor in the AI story.
Okay, now this is where it gets really crazy. PJM, that's the grid operator for a huge chunk of the eastern U.S., including Virginia's famous data center alley. They run these auctions to make sure there's enough power capacity for the future. Well, look what just happened to the price they had to pay. It went from under $30 per megawatt day to almost $330. This isn't just supply and demand anymore. This is what the source calls a desperation premium.
Yeah, a price spike of over 1,000% in a single auction cycle. This is not a gradual trend. This is a market that is screaming at the top of its lungs that reliable power has suddenly become one of the most valuable things in the world, and there just isn't enough of it. So, you put it all together. You've got this explosive AI demand, a historical economic tailwind from interest rates, and real-world prices going completely parabolic. All of this leads to the core of the thesis, the idea that the financial markets are completely, utterly asleep at the wheel.
It's the key question, isn't it? If the entire world for utilities has been turned upside down, why does the market seem to be pricing it like nothing has changed at all? Well, the answer might just be that these huge institutions, they're running on old models that haven't been updated for this brand new reality. And you can see this reality best through a concept called implied volatility.
It's actually pretty simple. Implied volatility, or IV, is just the market's expectation of how much a stock is going to move around in the future. The easiest way to think about it is as the price of insurance on that stock. If IV is high, the market expects big swings, so insurance is expensive. If IV is low, the market expects calm seas.
And here's the punchline.
Despite everything we have just talked about, the implied volatility for XLU, that's the main fund that tracks the utilities sector, has been stuck in the exact same low range for over 20 years. The market's excitement gauge hasn't moved an inch. It is still pricing utilities like they're the same old boring sector they were back in 2007.
This quote from the source material just absolutely nails it. The fundamental reality on the ground has changed completely, but the financial price tag hasn't caught up. And that gap, that space between perception and reality, that's what creates a potentially asymmetric opportunity, where the upside could be many, many times larger than the downside.
But of course, no thesis is a sure thing. It's always crucial to look at the other side of the coin and really understand the risks that could make this entire argument fall completely apart.
And look, the risks are very real. If inflation stays stubborn and forces the Fed to raise rates instead of cutting them, that would be a huge headwind. What if there's a major breakthrough in AI efficiency that slashes power demand forecasts? That would make a lot of this new infrastructure less necessary. And maybe the biggest one of all, we all know how slow and painful it is to build new grid infrastructure in the US. All the regulations, the permitting battles, these are all very real things that could invalidate the whole thesis.
So we'll leave you with this final thought to chew on. For years, the story of tech progress has always been about smaller, faster chips. But maybe, just maybe, we've hit a turning point. Maybe the next great challenge and the next great opportunity isn't about computation at all, but about something far more basic, just having enough plugs to power our future.